There's a building in Midtown Manhattan where the lights never fully turn off. Not because someone forgot, because someone's always there. 23 years old, sitting in a Herman Miller chair that costs more than their first car, formatting a pitch deck for a deal that may never close, eating cold seamless at 1 a.m. on a Tuesday, wondering, with genuine confusion, whether this is winning or losing. Investment banking is one of the only careers on earth where the entry-level compensation makes your parents proud, and the entry-level lifestyle makes them concerned. Where the business cards are beautiful and the hours are criminal. Where you will learn more about corporate finance in 6 months than most people learn in a lifetime, and more about human endurance than you ever wanted to. This is not a normal job. It is a system. A tower with floors, each one quieter, richer, and stranger than the last. And every person inside it is either climbing, clinging, or calculating their exit. From the analyst grinding pitch books at 2 a.m. to the managing director whose handshake is worth more than your annual salary, every level of investment banking has its own rewards, its own rituals, and its own very specific form of suffering. This is what it's actually like, floor by floor. 1. Analyst, the proving ground. You arrive on a Monday in July. New suit, new ID badge, new email signature that you will, embarrassingly, screenshot and send to at least 3 people. You are an investment banking analyst, which sounds powerful, until you realize it mostly means you are the most expensive intern who's ever been trusted with a stapler and a financial model. Your class is 20, maybe 30 people. All of them were top of something. Top of their class, top of their campus, top of some ranking that felt like it mattered 6 months ago. Now you're all sitting in the same orientation room, wearing the same neutral expressions, silently measuring each other. The hierarchy hasn't started yet. It will. The first few weeks are training. You learn accounting. You learn valuation. You learn Excel shortcuts that will become more instinctive than your own phone number. You learn that there is a right way to format a page, a right font size for a header, a right shade of blue for a bank logo, and that getting any of these wrong at midnight will earn you a correction email written with the restrained fury of someone who has not slept since Thursday. Then you get staffed on your first live deal, and the actual job begins. Your life now operates on someone else's clock, not your clock, not even normal business hours. Your clock is set by a vice president who sends you a message at 9:47 p.m. that says, "Quick turn," which is banking shorthand for, "I need this in 4 hours. Do not ask questions, do not sleep." You will learn to fear the phrase "quick turn" the way civilians fear turbulence. Your days have no shape. You wake up, you go to the office, and you stay until someone tells you to stop. Or, more often, until the work simply runs out for the night. 11 p.m. is early. Midnight is normal. 2 a.m. is a Tuesday. You will eat dinner at your desk so often that the smell of reheated Thai food becomes emotionally triggering. And the work itself? It's not glamorous. You're not advising CEOs. You're building models. You're pulling comps. You're formatting slides with a level of precision usually reserved for heart surgery. You're updating a CIM for the 6th time because a senior banker decided the margins on page 14 feel off. You're printing pitch books at 3 a.m. and praying the color printer doesn't jam because if it does, you will be the one fixing it while a car waits downstairs. But here's the thing no one outside the building understands. You are learning fast, violently fast. The sheer volume of reps, the models, the decks, the deal structures pours into your brain whether you want it to or not. Within 6 months, you can look at a balance sheet and see things your friends in other industries won't understand for a decade. The compensation is strong. First year, all in, you're somewhere north of $200K, which would be extraordinary if you had any time to spend it. But you don't. Your apartment is a place where you occasionally shower. Your hobbies are a memory. Your friendships exist primarily in group chats you read but rarely answer. And the unspoken truth, the real currency at this level isn't money. It's survival. The bank is watching. Your staffer is watching. Your associate is watching. Every model you build, every turn you execute, every email you send at 4 a.m. is a tiny, silent performance review. The analysts who stay composed, who don't complain visibly, who deliver clean work under impossible conditions, those are the ones who get staffed on the best deals, who earn the best reviews, who receive the offer to stay. Everyone else becomes a cautionary tale told over drinks at a bar you no longer have time to visit. You are at the bottom of the tower. The lights are fluorescent. The air smells like ambition and dry erase markers. But you're inside, and from here, the only direction is up, assuming you survive the climb. 2. Associate, the machine operator. You've been promoted, or more likely, you've arrived fresh from a top MBA program, carrying $200,000 in student debt and the quiet confidence of someone who believes a degree from Wharton or Harvard Business School entitles them to skip the suffering. It doesn't. The associate role is the level where investment banking stops being about endurance and starts being about judgment. You are no longer the person building the model. You are the person checking it, owning it, defending it. When the numbers are wrong, the analyst made the mistake. When the numbers are wrong and no one caught it, that's on you. Your title has changed. Your hours have not. This is one of the great lies of the associate promotion. You are told you are moving up, but your calendar looks almost identical, just with more meetings and more responsibility. You still stay late. You still work weekends. But now, instead of just executing, you are managing. You are the bridge between the analysts who do the work and the vice presidents who want it done yesterday. This is harder than it sounds. On one side, you have analysts who are exhausted, resentful, and occasionally incompetent at 2 a.m. On the other side, you have a VP who sends feedback in 3 words, "Not quite right," and expects you to decode what that means and fix it in an hour. You are the translator, the shock absorber, the person who turns chaos into a clean deliverable. You learn project management not from a course, but from desperation. You learn to track 15 work streams at once, to know which analyst can be trusted with a model and which one needs their formulas audited cell by cell. You learn to manage up, to anticipate what a VP wants before they ask for it. Because in banking, the associate who has to be told twice is the associate who gets staffed last. The money improves, somewhere between $300,000 and $400,000 all in, depending on the bank and the year. The debt from business school begins, slowly, to feel like it was worth it. You start noticing your non-banking friends' lifestyles and realizing, with a complicated mix of pride and sadness, that you're pulling ahead financially. You're also pulling away socially, but you don't think about that yet. Your identity begins to shift. As an analyst, you were a grunt, disposable, interchangeable. As an associate, you start to matter. Senior bankers learn your name. You're copied on emails you wouldn't have seen a year ago. You're invited into client calls, not to speak, not yet, but to listen, to absorb, to begin understanding that investment banking is not actually about spreadsheets. It's about relationships, trust, and the precise management of other people's anxiety. The unspoken rule at this level is simple. Don't make anyone above you look bad. Your VP's presentation must be flawless. Your MD's talking points must be airtight. Your job is to make the machine run so smoothly that the people above you never have to think about the gears. If they notice you, it should only be because you made them look brilliant. The associates who understand this rise. The ones who don't, the ones who push back too often, who miss details, who treat the role like a waypoint instead of a craft, they start getting quieter assignments, smaller deals, less access. The system doesn't punish you loudly.
It simply stops inviting you into the room.
There is a specific loneliness at this level that no one prepares you for. You're too senior to commiserate with the analysts. You're too junior to relax around the VPs. You exist in a professional no man's land, respected by no one fully and relied upon by everyone constantly. You're the engine of the bank, the person who actually makes the deals move. And the reward for doing it well is the opportunity to do more of it, faster, with higher stakes. Welcome to the middle of the tower. The view hasn't changed much, but the weight has. 3. Vice President, the invisible architect. This is the level where the job changes shape entirely, and where most people outside of banking stop understanding what you actually do. You are a vice president now, which in any normal company would mean something. In investment banking, it means you have graduated from execution into orchestration. You are no longer building the machine or checking the machine. You are running it. Multiple deals, multiple teams, multiple clients who all believe their transaction is the only one that matters. Your days are no longer measured in tasks. They are measured in decisions. Which analyst gets staffed where? Which associate can handle the complexity of a cross-border M&A model? Which client needs a call this week before they start entertaining pitches from a rival bank? Which MD needs to be prepped before a board meeting so they don't walk in and say something that unravels 3 months of positioning? You are, for the first time, genuinely responsible for outcomes, not just deliverables, outcomes. If a deal falls apart because the process was mismanaged, that's your name attached to the wreckage. If a pitch fails because the book wasn't sharp enough, the MD won't remember who built the slides. They'll remember who was supposed to make sure the slides were perfect. The pressure at this level is quieter, but heavier. As an analyst, the pressure was physical, sheer hours, sheer fatigue. As a VP, the pressure is cognitive and political. You are managing up, managing down, and managing sideways, all simultaneously. You are learning which MDs are worth attaching yourself to and which ones are slowly losing influence. You are reading rooms. You are noticing who gets invited to the offsite and who doesn't. You are beginning to understand that the org chart is a lie, and the real power structure is a web of relationships, favors, and unspoken alliances that no one will ever draw on a whiteboard. Your compensation crosses into serious territory. $500,000 to $700,000, sometimes more in a strong year. You buy the apartment. You take the vacation, occasionally. You own the watch that signals to other people in the industry that you've reached a certain altitude. But the money, strangely, starts to feel less like a reward and more like a retention device. The bank is paying you enough to make leaving painful, not enough to make staying feel easy. Here is the brutal math of the VP level. You are too expensive to be disposable, but too junior to be powerful. You are essential to the operation, but you are not the one deciding which operations matter. You execute strategy, you don't set it. And every year, you watch the MDs above you take the client calls, close the dinners, and collect the credit for deals that you quarterbacked from the first pitch to the final signing. The lifestyle adjusts, but not as much as you were promised. You still work weekends, not every weekend, but enough that your partner has stopped asking, "Will you be free Saturday?" and started asking, "Which Saturday?" You still take calls at dinner. You still check your email with a frequency that a therapist would gently describe as compulsive. The difference is that now, the calls are higher stakes, and the emails are more political. You begin to develop a sixth sense for tone. You can read an MD's mood from a 2-word Slack message. You can feel when a deal is going sideways before anyone says it out loud. You can tell within 5 minutes of a client meeting whether the CEO actually wants to sell or is just using your bank for a valuation to wave at their board. This is the level where the human machinery of banking becomes fully visible to you. You see how promotions really work. Not through merit alone, but through sponsorship, visibility, and the careful cultivation of relationships with the people who control the compensation committee. You see how certain bankers protect their turf, how coverage heads guard their client relationships like family heirlooms, how a single misplaced comment in a review meeting can stall someone's career for 2 years. And you begin to make a calculation that every VP eventually confronts. Do I want the next level? Because the next level, director, senior vice president, whatever your bank calls it, is the last stop before managing director. And managing director is where the game changes completely. More money, more power, more exposure, and a kind of pressure that makes everything you've experienced so far feel like a warm-up. Some VPs look up and decide to keep climbing. Some look up and quietly start taking calls from private equity firms, hedge funds, corporate development teams, anywhere the hours are softer and the politics are less surgical. The ones who stay do so for a specific reason, not money, not prestige, something harder to name, a need to see how high the tower actually goes. You're past the middle floors now. The air is thinner, the rooms are smaller, and the people in them are watching each other very carefully.
4. Director/Senior Vice President, the last gate, investment banking. This level has a dozen names depending on the bank. Director, Senior Vice President, Executive Director, the title varies, the function doesn't. You're standing at the last checkpoint before the only title in banking that truly matters. Managing Director. Everything about the director level is shaped by that proximity. You're close enough to see the corner office, close enough to understand exactly what it costs, and close enough to know that not everyone standing where you're standing is going to make it through. Your job now is a strange hybrid. You are still running deals, large, complex, high-profile transactions that require genuine expertise and constant client contact. But you're also, for the first time, expected to originate, to bring in business, to develop relationships with CEOs, CFOs, and board members who have no obligation to take your call, to prove that you are not just an operator, but a rainmaker. This is the transition that breaks people. Execution is a skill. It can be taught, refined, perfected through repetition. Origination is something else entirely. It requires charm without desperation, confidence without arrogance, the ability to walk into a room full of people who run billion-dollar companies and make them believe that you, specifically you, are the banker they should trust with the most consequential financial decision of their career. Some directors are natural at this. They have the presence, the Rolodex, the instinct for when to pitch and when to listen. Others are extraordinary operators who have spent 15 years perfecting the art of execution and now discover, with quiet horror, that the skill set that got them here is not the skill set that gets them there. The politics at this level are exquisite. Not loud, not dramatic, exquisite. You are being evaluated constantly, but the evaluation is invisible. It happens in hallway conversations you're not part of, in compensation committee meetings where your name is discussed for 45 seconds, in the way an MD introduces you to a client as one of our best, or merely as part of the team. The difference between those two phrases is the difference between a promotion and another year of waiting. Compensation ranges from $700,000 to over $1 million. On paper, you have arrived. In practice, you are in the most precarious position of your career. You are expensive. The bank expects a return on that expense, and the return they expect is revenue. Your revenue attached to your name, traceable to your relationships. If you can demonstrate that clients pick up the phone because of you, the path to MD opens. If you cannot, the bank will keep you, for now, but the ceiling becomes visible, and everyone, including you, can feel it. Your personal life at this stage is either deeply stable or quietly dissolving. The The directors who survive tend to have partners who understand, truly understand that this career is not a job, but a condition. That Saturday morning might be interrupted, that the vacation might be cut short, that the phone is never really off. The ones who don't have that understanding at home often find that the cracks long ignored are now impossible to hide. There's a specific emotional texture to this level that outsiders never see. You have spent a decade and a half inside a system that promised you the world if you just kept performing. And you have performed. Relentlessly. Brilliantly even. But now, standing one level below the summit, you realize something unsettling. The final promotion is not entirely in your control. It depends on timing, on headcount, on whether the bank is expanding or contracting, on whether the MD above you retires or stays or gets poached, on whether the group head likes you, not respects you, likes you. You can do everything right and still wait. And waiting at this altitude, with this salary, with this title, with this much of your identity invested in the outcome, waiting is its own particular kind of suffering. The directors who eventually break through will tell you later that this was the hardest level. Not the analyst years, not the associate grind. This, the last gate. Where the pressure was silent, the stakes were existential, and the only thing standing between you and the top was a door that someone else controlled. 5. Managing Director. The arrival. You made it. 2 words you've waited a decade or more to hear in a phone call from the group head, delivered with the casual warmth of someone who knows exactly how much power they just handed you. Congratulations, you've been elected Managing Director. Elected. That's the word they use, not promoted. Elected. As if it were a political office, which in many ways it is. This is the title. The one that restructures your entire existence. The one that changes how clients greet you, how analysts look at you, how headhunters address their emails. Managing Director. In investment banking, those 2 words carry more weight than virtually any other professional designation on earth. They are a signal to the market, to the industry, to every person you will ever sit across from in a conference room, that you have survived one of the most brutal meritocratic filters ever designed and emerged on the other side. Your compensation reflects the elevation. New MDs typically see total packages between $1 million and $2 million in their early years. The top performers, the ones running marquee deals, advising the most powerful clients, generating tens of millions in fees, will earn significantly more. The bonus is the majority of your pay, and the bonus is a direct function of what you killed. This is the level where banking becomes, finally and explicitly, a hunting economy. Your job is no longer about managing process, it is about owning relationships. You are the face the client sees, the voice on the call when the CEO is nervous about a hostile bid, the person in the boardroom when the deal gets complicated and everyone else in the room is looking for someone who radiates certainty. Whether you feel it or not, you are expected to generate revenue. Consistently, year after year, the number is tracked, discussed, compared to your peers in ways you will never be told about directly but will always feel. A slow year doesn't end your career, but 2 slow years in a row starts a quiet conversation somewhere above you about whether your relationships are still producing, whether your sector is still active, whether the bank's capital is better deployed behind someone else. This is the paradox of the MD title. You have more power than you've ever had and more exposure than you've ever faced. Every deal you win is visible. Every deal you lose is visible. Every client you keep is noted. Every client who drifts to a competitor is a data point in someone's evaluation of your franchise value. The lifestyle shifts in ways that are both liberating and disorienting. You no longer sit in the bullpen. Your calendar is not dictated by a staffer. You fly business class without thinking about it, stay at hotels that don't require justification, and dine at restaurants where the maitre d' knows your bank's name before you say it. These are not perks. They are tools. The dinner is a client meeting. The flight is to a board presentation. The hotel is where you'll prep for the most important pitch of the quarter. But the freedom is selective. You are free from the grunt work, yes. You're not free from the pressure. The pressure, in fact, has never been more personal. As an analyst, failure was collective. As an MD, failure has your signature on it. Your reputation, painstakingly built over 15 years of late nights, perfect decks, and carefully managed relationships, is now the product you're selling. And reputations in banking are earned in decades and lost in quarters. Internally, you navigate a landscape of peers who are simultaneously your colleagues and your competitors. The MD pool at a major bank is not a team. It is an ecosystem. There are alliances, rivalries, territory disputes over client coverage, quiet campaigns for leadership roles, and beneath it all, a constant, ambient awareness of compensation, who earned what, who was paid above the line, who was sent a message through their bonus that their franchise is declining. You attend the dinners now, the ones that matter, with the CEO, with the board chair, with the private equity partner who controls a $40 billion fund. You have opinions that people pay to hear. You have access that people spend entire careers trying to earn. And somewhere late on a Sunday night, in the back of a town car heading home from an airport, you will have a thought that surprises you with its clarity. This is everything you worked for. And it is not enough. Not because the money is insufficient, not because the title is hollow, but because the machine doesn't stop. There is no floor where the climbing ends and the living begins. There is only the next deal, the next client, the next year's number. You have arrived at the top of the tower. The view is extraordinary. The wind is constant, and the only thing more expensive than getting here is staying. 6. Group head/head of division, the inner circle. There is a level above managing director that most people outside of banking don't know exists. It doesn't always come with a formal title change. Sometimes it's head of M&A. Sometimes it's global head of industrials. Sometimes it's co-head of investment banking. The words vary. The meaning doesn't. You're no longer just a producer. You are the person who decides what the bank produces. This is the shift that separates the rainmakers from the power brokers. An MD generates revenue, a group head allocates capital, sets strategy, controls hiring, determines compensation for dozens, sometimes hundreds, of bankers, and shapes the bank's identity in the market. You're no longer playing the game. You're designing the board. The path here is narrow and unsentimental. For every 50 MDs at a bulge bracket bank, perhaps 3 or 4 will ascend to run a group or a division. The selection process is part performance, part politics, and part timing. A constellation of factors so specific and so fragile that even the most talented bankers can spend years positioned perfectly and still watch the role go to someone else because of a leadership change, a strategic pivot, or a single relationship that tipped the balance in a room they were never invited into. Your compensation, if you reach this level, enters a different atmosphere. $3 million, $5 million, sometimes considerably more. The number is no longer just a reflection of your personal revenue. It's a reflection of your institutional value, the deals your group closes, the talent you retain, the clients who stay loyal to the bank because they are loyal to you. But the nature of the money changes. A meaningful portion of your compensation is now deferred. Stock, restricted units, long-term incentive plans designed with exquisite precision to ensure that your financial interests are permanently entangled with the banks. You are no longer simply paid. You are invested, locked in, bound by golden handcuffs so elegant you almost forget they're handcuffs at all. Your days look nothing like they did when you were an analyst staring at a pitch book at 2 a.m. Your calendar is a diplomatic document. Every meeting is a negotiation with clients, with competitors, with regulators, with your own colleagues who run adjacent groups and want a larger share of the fee pool. You spend more time on the phone with the CEO of the bank than you do with your own team. You are consulted on decisions that affect the firm's direction, which sectors to expand into, which offices to open, which competitors to poach from, which underperforming MDs to quietly manage out. This is the level where you learn that leadership in banking is not about inspiration. It is about resource allocation and psychological management. Your top producers need to feel valued or they leave. Your underperformers need to feel pressure or they coast. Your mid-tier bankers need to feel possibility or they disengage. And all of them, every single one, are watching your decisions for signals about their own future. The politics are no longer exquisite. They are architectural. You are building coalitions with other group heads. You're positioning yourself or resisting being positioned for a seat on the management committee. You are managing your relationship with the CEO, who respects you as long as your group's numbers justify your autonomy and will restructure you out of existence the moment they don't. There is a particular loneliness at this altitude that no compensation package can address. Your peers are your competitors. Your subordinates are your dependents. Your superiors, if you still have them, are evaluating you with the detached clarity of people who have made harder decisions than letting someone go. You cannot be fully honest with anyone inside the building, not because you're dishonest, because honesty at this level is a vulnerability that others will use. Your external life has bifurcated completely. To the outside world, you are a success story of almost mythological proportions. Your name appears in deal tombstones, in league table rankings, occasionally in the Financial Times. You sit on non-profit boards. You attend Davos. You are invited to dinners where the guest list is the point. Your children attend schools where the tuition rivals a mortgage payment and no one around you blinks. But inside, you are managing a machine that runs on anxiety, ambition, and quarterly results. You are responsible for hundreds of careers, billions of dollars in transaction volume, and a reputation that belongs not just to you, but to the institution itself. Every strategic bet you make is scrutinized. Every hire you champion is a reflection of your judgment. Every client you lose is a story that your rivals will tell with carefully calibrated sympathy. And the question that haunts this level is not, can I keep performing? It's what happens when I stop. Because the bank does not sentimentalize tenure. There is no lifetime achievement award. There is only this year's number, this year's market share, this year's retention rate. The moment your value to the institution declines, the institution will find a polite, expensive, and ruthlessly efficient way to help you toward the door. You are inside the innermost room now. The furniture is beautiful, the silence is immense, and every single person sitting at this table knows that the chairs are borrowed. 7. The C-suite path, the final translation. A very small number of bankers reach a place that most of the industry will never see from the inside. Not because it's hidden, it's the opposite. It is the most visible seat in the building. CEO President, Chief Operating Officer, the executive suite of a major investment bank. This is not a promotion in the traditional sense. It is a translation. You're no longer a banker. You're a corporate leader, a public figure, a fiduciary to shareholders, a diplomat to regulators, a strategist accountable to a board of directors who can remove you with a vote and a press release. The handful of people who reach this level, and at any given moment across the entire industry, there may be fewer than 20 who hold these roles at globally significant banks, have survived a selection process so layered and so opaque that even the participants can't fully explain how it happened. It involves years of positioning, sponsorship from the right predecessors, a track record that can withstand the scrutiny of a board committee, and a temperament suited to the specific, exhausting demands of leading an institution that is simultaneously a business, a political target, and a cultural symbol. Your compensation is now public, filed with the SEC, printed in proxy statements, discussed on cable television by people who have never met you. $10 million, $20 million, $30 million. The numbers are enormous, and they are also, in a strange way, the least interesting thing about the job, because the job itself is no longer about money. It is about legacy, survival, and the daily management of forces that no single person fully controls. You testify before Congress. You sit across from regulators who view your institution with a suspicion that ranges from professional to personal. You navigate a media landscape where a single misquoted sentence can move your stock price, trigger a compliance review, or become the centerpiece of a narrative you never intended. You manage a workforce of tens of thousands, most of whom you will never meet, and a culture that was shaped decades before you arrived and will persist decades after you leave. The pressure is no longer quarterly. It is existential. a credit crisis, a rogue trader, a liquidity event, a pandemic. The scenarios that keep you awake are not about missed earnings. They are about institutional collapse, about being the person holding the wheel when the machine threatens to come apart. Your calendar is no longer yours. It belongs to the Chief of Staff, the communications team, the Government Affairs Office, and the board. You eat lunch at your desk not because you're grinding on a model, but because there is physically no unscheduled time between your 11 a.m. with the Fed and your 1 p.m. with the board's risk committee. You fly private, not as a luxury but as a logistical necessity, because the schedule does not accommodate commercial flight delays, airport terminals, or the inefficiency of being recognized in a Delta Sky Club. Your relationships have been permanently restructured by power. Old friends from the trading floor treat you differently now. Colleagues who were once your equals now calibrate every sentence they say in your presence. Your direct reports manage you as carefully as you once managed the MDs above you. The honesty that once existed in your professional relationships has been replaced by something more careful, more strategic, and more isolating. And yet, there is something at this level that exists nowhere else in the tower. You can see the entire system, every flaw, every incentive, every contradiction. You understand with a clarity that took 30 years to develop exactly how the machine works, who it rewards, who it discards, what it values, and what it pretends to value. You understand that investment banking is not, at its core, a financial business. It is a human business, a business built on the willingness of extraordinarily talented people to trade their time, their health, their relationships, and their identity for a seat at a table that is always being rearranged. 8. The exit. Or the truth about the tower. Here is what no one tells you on your first day in the Analyst class, sitting in that orientation room with your new badge and your pressed suit and your quiet electric ambition. The tower doesn't have a top. It has levels, each one shinier, quieter, and more expensive than the last. Each one promising that the next one is where the work finally feels worth it, where the freedom arrives, where the sacrifice converts into something permanent. But it doesn't, not really, because the system isn't designed to deliver satisfaction, it's designed to deliver performance. And it does that by keeping the carrot one floor above wherever you happen to stand. The analyst believes the associate has it easier. The associate envies the VP's autonomy. The VP covets the MD's client access. The MD watches the group headset strategy and wonders what it would feel like to hold that lever. The group head-eyes the C-suite and imagines what true institutional power must be like. And the CEO, the person who sits at the very top of the building behind the thickest door on the quietest floor, the CEO knows something that everyone below them suspects, but no one wants to confirm. There is no floor where the pressure disappears. There is only a floor where the pressure becomes yours alone. Investment banking will give you things that very few careers on earth can offer. Financial security that most people only dream about. An education in how capital moves, how power operates, how decisions get made inside the rooms that shape the global economy. A professional identity so polished, so recognizable that it precedes you into every room for the rest of your life. But it will also take quietly, relentlessly, with the patience of an institution that has been doing this long before you arrived and will continue long after you leave. It will take your weekends, your sleep, your hobbies, your presence at dinners that mattered more than you realized at the time. It will take the version of yourself that existed before you learned to read a room for political subtext, before you started measuring people by their titles, before your instinct for self-preservation became sharper than your instinct for joy. The people who thrive in this system, truly thrive, not just survive, are the ones who understand this bargain clearly and make it with open eyes. Who climb not because they're chasing an illusion, but because they genuinely want what the climb offers. Intensity, excellence, proximity to consequential decisions, and the rare, addictive satisfaction of operating at the highest level of a brutally competitive craft. The ones who suffer most are the ones who keep waiting for a floor that isn't there, who keep believing that the next title, the next bonus, the next deal will be the one that finally makes the sacrifice feel complete. It won't. The tower doesn't work that way. It gives you the view, it just never lets you stop climbing long enough to enjoy it. This has been HighTable OS. If the lights in your building are still on, you already understand everything we just said. If they're not, consider yourself lucky or reconsider your ambition. Either way, the tower is open. The elevator is waiting, and no one inside is going to warn you about the cost of the ride.